Introduction to Financial Forecasting. Welcome to the chapter on financial forecasting. Financial forecasting is one of the key skills involved in business generally and also in financial analysis. What we're going to do in this chapter is learn about how to take the state of the firm today, look at what's happened in the past, come up with a reasonable set of assumptions, and project into the future. The important thing to remember here is that when we're projecting what's going to happen in the future, we are not trying to make a detailed roadmap. That is, we're not trying to say that, well, given these assumptions, we're going to forecast the financial statements for the next 5 years, and that's exactly what the firm's going to look like over that 5-year period. Rather, what we're trying to do is to know what is knowable. We all realize that the future will unfold in ways that we can't anticipate. Therefore, our projections and what actually happens are not going to match, but what we are going to achieve is we're going to be able to know what is knowable, and therefore we're going to avoid making stupid mistakes. So we're going to take what we know about the firm today, we're going to make our assumptions, we're going to project, and as a result, we're hoping to make decisions that are better informed and then allow us to make decisions that are going to optimize the firm going forward. Goals of financial planning understand important linkages in the next few lessons. You will uncover important linkages as you learn about financial forecasting. Some examples of such linkages are those between revenues, expenses, and investments in fixed assets for growth and the financing of such assets. A solid financial model will allow you to see how changes in cost structures or sales growth will impact your future cash flows, financing needs, and cash budgeting. Even though some of these linkages are easily identified, many are difficult to see, and a good model reveals such linkages. For example, assume that a company invests in equipment that is more efficient. This will help the business reduce production costs, and in a competitive market, the company can gain a competitive advantage by reducing prices. Reductions in prices then lead to more sales. At the same time, this decision will involve not only new equipment but potentially a new plant to put the equipment in. This means that the company needs extra capital to purchase both the equipment and the plant. If you finance them, a potential tax shield may be created by interest expense on top of the depreciation of the assets. Because there are so many linkages involved in finance, financial forecasting and modeling will help the financial manager understand the business and achieve the goal of the firm to maximize owner wealth. Spontaneous and discretionary accounts. One of the most important influences on financial forecasting comes from a company's growth in sales. Consider a company that is expecting to grow at 10% next year. What accounts are generally correlated with changes in sales? If you look at an income statement, for example, cost of goods sold is an obvious one. You would expect COGS to grow at or close to 10% with sales. How about balance sheet items? If sales go up by 10%, then cash sales and credit sales will probably go up by 10%, and you will want to hold approximately 10% more inventory to meet the sales volume. Since you will need more inventory, you will have to purchase 10% more materials from suppliers as well. Spontaneous accounts are those that vary naturally with sales. That is, as sales increase, some accounts such as accounts receivable, inventory, and accounts payable automatically increase as well. Spontaneous assets and liabilities are normally automatically accumulated as a result of a firm's day-to-day business activities. For example, assume that a company produces and sells cars. If the company anticipates sales growth in cars, it orders raw materials to manufacture more cars and holds more finished cars to increase its inventory and meet the sales growth. When raw materials are purchased, the accounts payable of the company increase as well. The sales growth also increases both the cash and accounts receivable accounts. The projected growth in spontaneous accounts is an important measure for companies to evaluate how much extra funding is needed to meet that growth. The opposite of spontaneous accounts are non-spontaneous accounts or discretionary accounts. For instance, if the car company expects a growth in sales, can we assume that the company's bank loans or bonds increase in proportion to the sales growth? The answer is no. If extra funds are needed, management tries to find a way to manage additional financing needs without getting new loans or issuing new stock if possible. These accounts do not increase automatically with sales, but are left to the discretion of management. You will learn about assumptions concerning which accounts are discretionary in the next lesson. The percent of sales method. Determining financing needs from a sales forecast instructor, there are a number of methods that we can use to forecast the financial condition of the firm in the future. However, the most common, and the one we're going to investigate here, is called percent of sales. The reason we call it the percent of sales method is because we're going to start with the sales forecast, and then we're going to relate everything else to sales. So we're going to look at the income statement. We're going to say, well, if sales grow by 10%, what's going to happen to cost of goods sold? Well, the reasonable assumption there might be that cost of goods sold would increase by 10% as well. So we're going to go through each line item on the income statement and ask ourselves, how will this line item change if sales grow by 10%? Then we'll go to the balance sheet. We'll start out on the asset side and look at cash. Well, how is cash going to change if sales change? How are inventories or accounts receivable going to change if sales change? So the key point here is to realize that we are going to relate everything we can back to our sales forecast. Now it's an important caveat to realize that there are some line items that are going to change as sales change. We call those spontaneous accounts. If sales grow, you would naturally expect cost of goods sold to grow. You would naturally expect inventories or accounts receivable or accounts payable to grow. There's other accounts that are line items that are not spontaneous. That would be something like long-term debt. Well, just because sales go up a little bit doesn't mean that you owe the bank or your bondholders any more than you did before. So the point here, or one of the key skills you're going to need to acquire early in this process, is to be able to look at the financial statements and to decide which of the line items are spontaneous and which are non-spontaneous, and then to integrate that into your forecast. Calculating the DFN, one of the main objectives of financial forecasting is to calculate the discretionary financing need, abbreviated DFN. You'll also see it elsewhere referred to as the EFN, or external financing need. The way to get this is actually quite simple. What you're going to do is you're going to start out by coming up with a forecast of the asset side of the balance sheet. In this case, I think terminology really supports intuition, so I like to call it the financing need. When I look at the assets, I say, this is my total financing need. Then I look at the financing side of the balance sheet. I do all my forecasting, take account of what is going to be spontaneous, add in the old accounts that aren't spontaneous, and I total up and I say, okay, now I have financing in place. Well, the DFN is essentially the difference between those two. So if we come up with total financing need, that is a projection of total assets at $1,000, and then we project financing in place to be $900. What's the trouble with that? Well, the balance sheet doesn't balance, right? Even the worst accountant in the world is going to make the balance sheet balance. So if you've got $1,000 in total financing need, only $900 in financing in place, what that's telling you is that, at your discretion, Mr. Chief Financial Officer, you have to go out and raise another $100. So the DFN is the amount that balances the financial statement. A total financing need of $1,000, financing in place at $900, therefore the DFN is going to be the missing piece, $100. Percent of sales method. Step 1, let's walk through the B&H Inc. example to find the discretionary financing need for the next year 20x8. The first thing we need to do is to project the sales and expenses into the upcoming year. The sales forecast for the upcoming year will come from the marketing department. Perhaps the marketing department will look at historical data, their expectations for the upcoming year, their market research or surveys to compile what they project to be the sales for the upcoming year. This information will then be provided to the financing department so that they can estimate what the projected sales revenues and expenses will be for the future year. In this problem, we are given that the sales in 20x7 were $32 million, and it's projected that sales in 20x8 will be $40 million with a net margin of 5%. We can then calculate the sales growth by taking the change in sales divided by the sales in the original year, or 20x7. This will help us to estimate by what percentage sales will grow from year 20x7 to 20x8. So for this example, we will take the change in sales by taking the projected sales in 20x8 of $40 million and subtracting from it the total sales in 20x7 of $32 million. We will then divide this by the sales in 20x7 to end up with the sales growth year over year of 25%. This is the first step in calculating the discretionary financing need. Percent of sales method. Step 2. The second step in forecasting the discretionary financing need is to forecast the change in the spontaneous balance sheet accounts. Before we can calculate this step, we first need to understand what a spontaneous account is. A spontaneous account is an account that varies proportionally or directly with sales. So sales increase, these accounts will increase as well. So if the sales go by 10%, the spontaneous account will grow by 10% as well. In this balance sheet, there are 5 accounts that are spontaneous. These include cash, accounts receivable, inventory, and then with liabilities, accounts payable and accrued expense accounts. To forecast what amount these spontaneous balance sheet accounts will be, we first need to understand what proportion of sales these accounts represent. We can do this by taking the previous year 20x7 numbers and divide it by the previous year's number of sales. This will give us the percentage of sales for each account. In 20x7, P&H Incorporated had a sales number of $32 million, so we will divide each of these accounts by that number, $32 million. For example, you can see here percentage of sales for cash. We divide the 20x7 cash number of $3.2 million divided by the total sales of $32 million to end up with cash representing 10% of sales. We will then do that for each of the accounts that are spontaneous. Accounts receivable will also be 10%. Inventory will be 5% of sales. Accounts payable will be 12.5% and accrued expense account will be also 12.5%. Once we have found the percent of sales, we can then project what the future amount will be in each of these accounts. This is done by multiplying the percent of sales by the projected sales by the upcoming year, which in this case will be 20x8. Since the projected sales amount for 20x8 is $40 million, we can then calculate cash by taking the $40 million multiplied by 10%, which represented the proportion of cash of sales, which ends up being $4 million in the cash account for 20x8. Similarly, with accounts receivable, we will take the $40 million multiplied by 10%, since accounts receivable represented 10% of sales, which ends up being an accounts receivable balance in 20x8 of $4 million. With inventory, we have $40 million multiplied by 5%, which ends up being $2 million in the account. Accounts payable, we have $40 million multiplied by 12.5%, which ends up being $5 million, and accrued expense, we also have $40 million multiplied by 12.5%, which ends up being $5 million for the upcoming 20x8 year. There's another year that applying the projected balance in the account for the upcoming year. This is done by multiplying the previous account balance times 1 plus the growth rate. Since we know that sales will increase by 25%, and these are all spontaneous accounts, so they will increase proportionally, we know that each of these accounts will also increase by 25%. As you can see, we can take the 20x7 account balance, such as in the projected cash balance, which is 3.2 in 20x7, and multiply it by 1 plus the growth rate, or 1 plus 0.25. Multiplying this, we end up with the same ending 20x8 cash balance of $4 million. Similarly, accounts receivable using this method will also be $4 million. Inventory will still be $2 million, and accounts receivable and accrued expense will still be $5 million each. Plugging in these account balances for spontaneous accounts, we can then project what the 20x8 current assets will be, which ends up totaling $10 million. This is the second step of calculating the discretionary financing need. Percent of sales method, step 3. The third step in calculating discretionary financing need is to deal with discretionary accounts. As we have learned, discretionary accounts are accounts that do not vary proportionally with sales. Instead, they change based on the discretion of management, or in other words, based on the choices and decisions of the firm and the strategy the firm chooses to take. In this problem, there are 3 accounts that are discretionary accounts. They include notes payable, long-term debt, and common stock. Note that each of these accounts are a way that the company could finance its operations or future projects. Again, these accounts will change based on the management discretion or management decisions that are chosen. To deal with discretionary accounts in our example, we're going to just carry the number over from 20x7 to 20x8. This will allow us to compare what the overall discretionary financing need may be, and then to allow management to determine the best way to finance any gap in funding. So in 20x7, notes payable is $1 million, long-term debt is $6 million, and common stock is $7 million. We will go ahead and write these numbers in 20x8 as well on the balance sheet. This is the third step in calculating discretionary financing need. Percent of sales method, step 4. The fourth step in calculating the discretionary financing needs is to estimate the fixed asset account. As we remember, the fixed asset accounts do not vary proportionately with sales, nor they do act specifically like discretionary accounts. Instead, fixed assets often vary based on the capacity needed to meet the required or projected sales amount. For B and H Inc. in 20x7, they had a net fixed asset account of $16 million. In the example given, the company feels that it needs an additional $2 million in fixed asset to support the projected sales level. To calculate the 20x8 fixed asset amount, then we will add this $2 million balance to the original 20x7 amount of $16 million. This provides us with an account balance for fixed assets in 20x8 of $18 million in total. This is the fourth step to find the discretionary financing need. Percent of sales method, step 5. The fifth step in calculating the discretionary financing need is to calculate the retained earnings account. We know that in 20x7, B and H Incorporated had a retained earnings account of $2 million. To calculate what the projected retained earnings will be in 20x8, we can use the equation, the projected retained earnings equal to the old or original balance of the retained earnings plus the projected sales multiplied by the net margin, multiplied by 1 minus the payout ratio. As you may remember, 1 minus the payout ratio is also called the retention ratio or plowback ratio. This is because it represents the amount of money that is being plowed back or put back into the firm for growth to their future opportunities instead of being paid out as dividends. You may wonder how this equation is related to the equation you may have learned in an accounting course, which is the projected retained earnings equal the old or beginning retained earnings plus net income minus the dividends. Let's break this down into parts. First of all, we can break net income into sales times the net margin. Since the net margin represents the percentage of sales that is retained as income. Next, we can break dividends into net income times payout ratio, since the payout ratio indicates what proportion is being paid out as dividends. Using these two equations, we can then find that net income times the quantity of 1 minus the payout ratio equals net income times the payout ratio, which, as we previously noted above, means that equals sales times net margin, which is the same as net income minus dividends, which is the same as net income times the payout ratio. When we apply this to the original equation at the top, we ultimately find just equals the proportion of net income that will be retained or plowed back into the firm. So all retained earnings plus the amount that's going back into the firm equals the projected retained earnings. And again, this can be calculated by all the retained earnings plus the quantity of projected sales times net margin times the plowback ratio, or in other words, 1 minus the payout ratio. We can now use this equation to calculate what the projected retained earnings will be for 20x8. First of all, we plug in the old retained earnings from 20x7, which was $2 million. We add this to the quantity of the $40 million in sales that will be in 20x8, multiplied by the net margin of 5%, multiplied by 1 minus the payout ratio. The example told us that the company B&H Incorporated has a payout ratio of 50%. This means we will multiply that by quantity of 1 minus 0.50. Multiplying this through and adding it to the 2 million, we end up with a projected retained earning in 20x8 of $3 million. Plugging the retained earnings into the 20x8 balance sheet and adding it to the common stock, we end up with a total equity in 20x8 of $10 million. This is how you calculate the projected retained earnings when you're seeking to find the discretionary financing need. Percent of sales method, step 6. The next step in calculating the discretionary financial need is to determine what the total financing need is. The total financing need is equal to the total assets. The total assets represent the different items that the company owns to generate the operations and sales projected into the upcoming year. In our example in 20x7, B&H Incorporated had total assets of $24 million. Since we have now calculated both the total current assets to be $10 million and the net fixed assets to be $18 million, we can now sum these to calculate what the total assets will be project for 20x8. Summing the $10 million and the $18 million, we end up with total projected assets of $28 million in 20x8. Somehow the company needs to finance its total assets, whether it does this through the liabilities or equity. Because of the need to finance these total assets, we called this total financing need. This is the sixth step to calculate the total discretionary financing need. Percent of sales method, step 7. The final step to calculate the discretionary financing need is to actually calculate the DFN, or the discretionary financing need. Before we do that, let's find the total liabilities and owner's equity. To do this, we simply add the total liabilities projected for 20x8 to the total equity projected for 20x8. The total liabilities in 20x8 is projected to be $17 million. Adding this to the total equity, which is projected to be $10 million, we end up with total liabilities and equity in 20x8 of $27 million. Now we can calculate the DFN, which is equal to the projected assets, which is the left-hand side of the balance sheet, minus the projected liabilities and equity, which is found on the right side. So calculating the DFN for 20x8, we find that total assets is $28 million less the total liabilities and equity, which is equal to $27 million, for a DFN of $1 million. So the discretionary financing need for B&H Inc. for the upcoming year of 20x8 is $1 million. The sustainable growth rate, 4 ways to decrease DFN. So let's assume that you now understand the basics of percent of sales forecasting. The trouble with percent of sales forecasting is that you can use any sales forecast you want, so your spreadsheet will accept any number that you want to put in there, and then you do your forecast and come up with your DFN. But the truth of the matter is that forecasting is a much more integrated process than what percent of sales might indicate. So we talk about sales growth, and that leads us to talk about asset growth. Well, how fast can assets grow? How much money can the firm borrow? Do they have to maintain particular relationships with their lender? Do the equity holders have particular requirements for dividend payments? All of those issues have to be included in the financial planning process for the firm. What we're doing in this section is we're moving on to look at the sustainability of the growth of the firm. So we're going to talk about sustainable growth rates. We'll analyze that via a tool called the DuPont method or the DuPont equation, and we're going to be able to take a much more integrative look at the firm and say, okay, we've got a sales forecast, but can we really sustain that type of growth in the long run? This is an involved topic, okay, it is certainly a higher level. It's not just been plugging into the algorithm, but it's vitally important in understanding what is possible for a particular firm. Using forecasting to determine fixed asset requirements. One thing we need to consider when we're forecasting asset needs is that not all assets can grow as a proportion of sales. For example, we have fixed assets. Often with fixed assets, we have a fixed asset that has a certain amount of capacity. For example, perhaps we have a machine that can make 1,000 units. As long as sales stay below 1,000 units, we can use this machine forever. But as sales continue to grow, we would then need to acquire another machine. This would happen such that, when we required the second machine, immediately we would jump to a capacity of 2,000 units. We then can continue to make sales until we reach a sales level above 2,000, when we would need to acquire yet another machine. Acquiring another machine would give us a capacity of 3,000 units, and so forth. As you can see here, it's not a smooth curve. As sales increase, the capacity does not increase in the same proportion, and the fixed assets that we need increase in what we would call a chunky manner. We can plan for this growth by anticipating what the sales amount will be, or the units that will be required, and what proportional fixed asset needs we will have. We can then anticipate when we will have those fixed asset needs, and when we need to start preparing to purchase those and implement them into our production. Introduction to Financial Forecasting. Financial forecasting helps us understand the implications of today's decisions on future performance. DFN is the additional financing needed given a firm's expectations for future growth, and finding DFN is one of the most important aspects of forecasting. Forecasting requires a number of assumptions, and the analyst needs to be careful with these assumptions or else the forecast will be inaccurate. Goals of financial planning. Financial forecasting uncovers important linkages given that expected actions are taken. Accounts that vary proportionally with sales are called spontaneous accounts. Accounts that do not vary proportionally with sales but are decided upon by management are called discretionary accounts. The percent of sales method. Determining financing needs from a sales forecast. Pro forma statements are projected estimates of a company's financial statements for a future period. The percent of sales method uses a sales forecast along with historical relationships between sales and other variables to produce pro forma financial statements. DFN is calculated as projected assets minus projected liabilities minus projected owner's equity. Fixed assets and retained earnings are special accounts that are not treated like either spontaneous or discretionary accounts. The sustainable growth rate. 4 ways to decrease DFN. The SGR is the growth rate at which a firm can grow without issuing new equity. The components of SGR are profitability, asset use efficiency, capital structure, and dividend policy. Controlling the variable that changes the SGR will decrease the DFN. Using forecasting to determine fixed asset requirements, the percent of sales method to project fixed assets is unrealistic because lumpy assets must be purchased as a whole. The sales capacity calculation. Given the current sales and current capacity, it's a tool to understand how much room a firm has for growth without additional investment in fixed assets. Summary. Reflect on the lessons you learned in this module. Financial forecasting is used for long-term planning. Financial forecasting helps us understand the implications of today's decisions on future performance. You learned the percent of sales method with its 7 steps, from sales estimation to calculation of DFN. Spontaneous accounts are those that vary with the sales growth, while discretionary accounts are based on management discretion. Fixed assets and retained earnings are special accounts that you need to pay attention to and are classified as neither spontaneous nor discretionary. The SGR is the rate at which a firm can grow without issuing new equity and gives insights on how to reduce the DFN. Calculating sales capacity can help you estimate whether you need to invest a lump sum in fixed assets to keep up with sales growth. What role does financial forecasting play in the future success and growth of a firm? Financial forecasting supplements historical data with proposed investments or changes to allow for more accurate foresight. What is the goal of financial forecasting? To understand the implications of today's decisions on tomorrow's performance, the goal of financial forecasting is to see the big picture of how financial decisions will affect future performance. Which question is answered by financial forecasting? How much financing will the firm need in the future? Finance forecasting helps us determine how much financing is needed in the future given today's business decisions and growth. How does financial forecasting help with financial decision-making? It helps decision-makers understand the impacts of today's actions on the future performance of the firm. What is one of the fundamental purposes of financial forecasting? To estimate how changes in cost structures or sales will impact the future cash flows and financing needs of the firm. A solid financial model will allow you to see how changes in cost structures or sales growth will impact the firm's future cash flows, financing needs, and cash budgeting. What are spontaneous accounts? Accounts that vary naturally with sales by definition. When sales increase, the increase must be matched in another account, such as receivables. Which type of account changes with sales growth? Spontaneous accounts. Spontaneous accounts vary naturally with sales. If a company expects sales to grow by 10% next year, which account might also increase by 10%? Cost of goods sold. Cost of goods sold is a spontaneous account, so if sales go up, you would expect the cost of goods sold to increase by a similar percentage. When can the discretionary financing needed, DFN, be determined? After pro forma financial statements are forecasted using the percent of sales method, once all the financial statements are projected according to a given set of assumptions, you can determine the financing required to fund the predicted growth in sales. Which action decreases the discretionary financing needed, DFN? Increasing the plowback ratio. Increasing the plowback ratio increases projected owner's equity and thus decreases DFN. You are a financial manager of a company and you have projected sales increase for next year of 8%. Which action would you take when you conduct financial forecasting using the percent of sales method? Leave the notes payable account constant in the projected financial statements. Notes payable is a discretionary account. Thus, you should leave it constant in the projected financial statements. You are conducting financial forecasting for your firm given the projected sales. What are you doing if you are estimating changes in the balance sheet based on the predicted change in sales? Forecasting spontaneous accounts. Spontaneous accounts change in proportion to sales growth. What is the sustainable growth rate, SGR? The growth rate that allows a firm to maintain its present financial ratios without issuing new equity. The SGR is the growth rate that allows a firm to maintain its present financial ratios without issuing new equity. How can a company reduce its discretionary financing needed, DFN? Increase the net margin. Increasing net margin increases the projected owner's equity, thus reducing the DFN. Which action increases a company's sustainable growth rate, SGR? Decreasing dividend payout. Decreasing dividend payout increases earnings retention and thus increases the SGR. Which account should be looked at first when examining capacity constraints to determine whether the discretionary financing needed, DFN, can be reduced? Fixed assets. You can recheck capacity analyses to verify whether the firm really needs as large of an increase in fixed assets as projected in the forecast. How can a firm grow its fixed assets if it is expecting growth but has reached capacity with its fixed assets? Invest a substantial amount of money at one time to increase capacity. Investments in fixed assets are capital intensive, meaning they require large payments at one point in time. What does the sales capacity equation tell you? How much room a firm has to grow without additional investment in fixed assets. By using the ratio of actual sales to percent of capacity, you can determine how much sales growth the firm can support without needing to invest in further fixed assets. What is discretionary financing needed, DFN? The additional financing needed given a firm's expected future growth. DFN is how much additional financing the firm will need given its expectations for future growth. You are a financial manager of a company. The marketing department has informed you that the projected sales growth for the upcoming year is 10%. As you conduct financial forecasting, you keep the long-term liabilities the same amount as the previous year, and we'll discuss this account with the other managers later. What type of account is long-term liabilities? Discretionary account. Discretionary accounts do not vary automatically with sales, but are left to the discretion of management. In this scenario, you kept the long-term liabilities account the same. What is the discretionary financing needed, DFN? Tell us. The total amount of funding that management will need to obtain through discretionary financing sources. DFN is the difference between the projected total assets and the projected total liabilities plus owner's equity. Any discrepancy between the sources and uses of finance is extra financing that management must obtain. Company ABC would like to continue to grow, but in order to maintain control of all decisions and ownership, it wants to avoid issuing new stock. Which calculation will show the company's leadership the fastest the ABC can grow? Sustainable growth rate. Sustainable growth rate is defined as the rate at which a firm can grow without issuing new equity. It implies that the firm's growth comes from the return on equity less any dividends. What is the major purpose of financial forecasting? To inform a company how business decisions will impact future growth. Correct. Financial forecasting helps decision makers understand how actions taken today can impact the firm's future performance.